a discussion I've seen recently about understanding the real cost benefits of renting versus buying and the unstated or often forgotten cost of home ownership. And it's for sure a question I get often. Isn't renting cheaper than buying right now given the high interest rates and rising home prices? I think it's a very fair question, and I thought it would be interesting to break this down in today's video. And so that way you can do your own cost analysis on whether renting or buying makes sense for you. So let's break it down. Hey y'all, welcome to the Living in Phoenix, Arizona channel. I'm Heidi Littleton, a realtor here in the Valley. If you're new here, this channel is about all things living, eating, playing, working in the Phoenix, Arizona area. If you're not new here, welcome back. Don't forget to hit the subscribe button and the bell so you get notified anytime I upload a new video. Now, before we dive in, I want you to know that I think it's really important that you do your own research on this topic to make sure that buying versus renting is an investment that makes sense for your budget and it aligns to your long-term financial goals. Obviously, I am biased towards buying real estate. I did choose a career as a realtor. I truly believe that real estate is the best path for long-term wealth building and can truly change people's lives and the legacy that they leave for future generations. And honestly, stats would back me up as 70% of most people's net worth is in home equity. However, I do know that there are a variety of ways to invest your money, and there are plenty of gurus out there who can share more about that. One last thing, as I've always preached in other videos, you should always use localized real estate data when making your decisions. So what I'm sharing today is specifically for Maricopa County and the Phoenix, Arizona area. If you're watching this in another state, all the numbers may not be relevant to your area, but the breakdown I give you should allow you to help you figure out the break even in your area. Okay, so one thing I've heard recently about buying a home is the unstated cost of owning a home. This includes increases in property taxes as well as home maintenance and repairs. And yes, this is absolutely true. So as you're determining your potential home buying budget, don't forget to take these into consideration because when they do happen, your budget becomes even more limited. Give yourself some wiggle room so you don't end up house poor. Having said all of that, I want to break down what it truly costs to rent versus buy over a 5-year period here in Maricopa County. And then I want to help you really figure out whether or not it makes sense for you to buy. Based on the most recent market data here in Maricopa County today is July 24th, 2023, the median rent is $2,250 and the median sales price is $439,000. This means that half the properties are more expensive than these numbers and half of the properties are less expensive. I prefer to use medians as they are less susceptible to outliers, which Phoenix absolutely has. I use a 7% interest rate for the mortgage, given that it has been on the higher end lately, and use an FHA loan because I think that's probably the most competitive homebuyer program right now, since it does tend to have a lower rate, less down payment, and then the newly reduced PMI standards. I'm also going to use a 4% for annual appreciation, as that was the rate of inflation for May 2023. However, looking at this graph, you can clearly see that our rate of appreciation has far exceeded this the past 5 years. So let's look at year one of renting versus buying. It is very obvious that renting clearly wins in this scenario. Renting a home is significantly cheaper in terms of the upfront cash you need compared to buying. When renting a house, you pay security deposit, cleaning or pet deposits, and typically first month's rent. And you will likely get some of that back at the end of your lease. So if you're for a $2,200 lease, you're looking at about $5,000 to $6,000 to get into a rental. Compare that to buying, where you'll need about $15,000 for down payment, $11,000 for closing costs, plus inspection and home warranty costs. Now, it is common in today's market to get help paying for closing costs and home warranty, but it's clear that buying is significantly more expensive up front. and your payment is almost $3,577. That's a $1,300 payment difference. So if you're looking at renting versus buying just over 1 year, even with 4% appreciation on a home, renting clearly makes sense. So if you're going to live in a home for only 1 year or so, look into renting. But of course, there are some caveats. The thing is, when people try to do a comparison of rent payment versus mortgage, they are just looking at the base number versus the components of a payment. Number one, you will be paying almost $4,000 towards your principal, which comes back to you in terms of home equity. It's a built-in savings account, right? Number two, the other thing that is making a popular comeback is mortgage interest tax deduction. Changes in the tax laws and then the low interest rates have made this tax deduction really irrelevant to many homeowners for many, many years. This itemized deduction allows homeowners to subtract mortgage interest from their taxable income, lowering the amount of taxes they owe. This deduction hasn't been a huge selling point for many years because annual interest payments from a mortgage have often been lower than the annual standard deduction for most households. For example, 5 years ago, the basic standard deduction was $12,000 for a single filer. Interest rates were around 4.6 and a median priced home was selling for $265,000. With 10% down, a monthly mortgage payment would have been about $1,200 a month. So over the course of the year, the buyer would have been paying around $11,200 in interest, making the standard deduction a better deal. Fast forward to 2023, the standard tax deduction is $13,850 for a single filer. The median home price today in the Valley is $439,000 with 3.5% down and today's interest rate of around 7%. Those numbers look a little different, making the use of the mortgage interest deduction much more attractive. In our scenario, you're looking at having a potential mortgage interest rate tax deduction of $29,500 removed from your taxable income. Of course, you should always talk with your tax or financial advisor for your specific situation. But this could make the conversation of rent versus own in year one a bit more interesting. Now, I'm always preaching that real estate is a long-term investment. Most people live in their first home for 5 to 8 years. So let's crunch what those numbers look like. So at year 5, your remaining principal balance is about $399,000. So if your home didn't appreciate at all, a single cent, you'd still have a little over $40,000 in equity. I don't know about you, but many I know would have a hard time saving up $40,000 in 5 years without some serious commitment. Again, that built-in savings account. Now, the reality is your home is likely to appreciate unless there is some sort of significant major issue. Clearly, I don't have a crystal ball, so I have no idea what the future holds. However, using the 4% rate of inflation from May 2023 for each year, you will see that your home could have a possible home value of $534,000. That's $95,000 in equity. Again, that is a huge built-in savings and a significant rate of return of 11.6 per year on average. I don't know about you, but I'm pretty sure any investor would take that rate of return. Add to that the option to refinance in 3 to 5 years if circumstances permit. If rates were to decline to 5.5%, you could refinance and save $480 a month. Now, once your home reaches that 22% loan to value somewhere near year 4-ish, you can refinance to remove PMI, saving you an additional $346. So that's a total of $800 a month, bringing your payment to about $2,800. Okay, Heidi, that all sounds great, but what about those forgotten home ownership costs you mentioned? Let's do the math on that. So in 5 years, you'll have $95,000 in possible equity. So let's subtract out the initial closing cost of $11,000 you spent, and let's say an extra $20,000 in repairs and property tax increases. And you would still walk away with over $64,000 in equity. Again, this is without taking into consideration a higher rate of appreciation, removal of PMI, mortgage interest tax deduction, refinancing to a lower interest rate, and any increases in rent. With all of those numbers, this number grows exponentially. Another factor you should take into consideration when deciding if now is better for you to rent or buy is the amount of competition you want to be up against. Right now, because interest rates are higher, it is impacting affordability. I mean, let's be honest, a payment at 7% is very different from one at 6, 5, or 3%. Reality is we are unlikely to see those 3% rates again. However, if and when rates do come down, all of that pent-up demand comes out. Combined with our low inventory, you are likely to be in a more competitive environment where prices are likely to increase, multiple offers may be common, and there may be fewer opportunities for seller concessions if those are important to you. So right now is a great opportunity to be able to have less competition and purchase a home if you can afford it. In the meantime, while others are waiting for rates to come down, you're going to be ahead of the game and will start building equity in your home. They always say the best time to buy a home was last year and the next best time is today. Last and most importantly, number one question to ask yourself when you're determining whether or not to buy at these higher rates is, can I afford this within my budget while also putting money aside for savings or paying down debt with little to no changes to your current lifestyle? If so, then I think buying is the perfect option right now. The other thing to consider is how long you're planning on staying in the home. If you're thinking about moving in a year or two, then renting may be a more beneficial path. If you're looking for a 3, 5, 7-year investment, I would say do the side-by-side number crunch, looking at the appreciation for your area with the cost of home ownership, like pest control, landscaping, pool service if needed, repairs or home warranty, and then compare that to the amount you'd pay in rent and what you would be doing with any savings if you didn't invest it in a home. And truly ask yourself, will I actually invest that potential savings? And if so, will it give me a better rate of return? Hopefully this breakdown gives you a direction to start doing your research on if buying or renting makes sense for you. If you found today's video helpful, I hope you will like, comment, and subscribe to the channel. And don't forget to send this on to a friend or family member who could use this valuable information. As always, if you have any questions about home ownership or what renting looks like and which one might be right for you, don't hesitate to give me a call, text, or email. Until next time.